Today, we're going to pull back the curtain on a hidden world, one run by algorithms that trade our markets at the speed of light. And what they do, well, it can influence everything, right down to the price of your groceries. So let's get right into it.
So let me ask you a question that sounds, well, impossible. Can a barrel of oil, something so fundamental to our lives, be worth less than zero? I mean, think about it. It just doesn't make sense, right? But what if I told you that not too long ago it actually happened?
And here's the proof. Take a look at this chart. See that box for crude oil up top? And you see that one lonely dot way out to the left? That's it. That's the moment in April 2020 when a specific type of oil contract didn't just hit zero, it went negative. We're talking nearly negative $40 a barrel. You literally would have been paid a hefty sum just to take the oil off someone's hands. This wasn't some glitch. It was a bizarre but very real signal coming from the very core of our financial system.
Okay, so how in the world does oil end up costing negative dollars? Was the system just broken, or was this our first real glimpse into a whole new set of rules for the market? All right, this is the key to the whole puzzle. That negative price, it wasn't for physical, actual oil that you could go pick up. No, it was for something called an oil futures contract. Think of it as a promise, a legally binding contract to take delivery of oil on a specific date. And these particular contracts were expiring right in the middle of the 2020 lockdowns. Demand had cratered, nobody was driving, and all the storage tanks were full. So if you were a trader stuck holding one of these contracts, you were about to have a tanker truck of oil show up at your door with absolutely nowhere to put it. People got so desperate they were willing to pay someone, anyone, to take that contract and that obligation off their hands.
Okay, so to really understand what's going on now, we got to take a quick step back and make sure we're all on the same page with some of the basics. We'll build a quick foundation with a few key terms.
First, commodities. Super simple. This is the raw stuff that makes the world go round. We're talking energy, metals, things we grow like coffee and corn. Basically, the physical ingredients of our entire global economy.
Next up, that thing we just talked about, the futures contract. This is the tool that lets people bet on the future price of those commodities. It's just a standardized agreement to buy or sell, say, gold or oil, at a price you lock in today for a date down the road. It's the engine of this whole market.
And the last one, arbitrage. This is the oldest trick in the book, really. It's all about spotting a tiny price difference for the exact same thing in two different places. You know, if a stock is a penny cheaper on one exchange than another, you buy it on the cheap one and sell it on the expensive one at the exact same time. It's a tiny but risk-free profit. And this idea, this is what started the insane race for speed.
You know, it really wasn't that long ago that trading was an entirely human game. You'd actually have to pick up the phone and call your broker. Maybe you had a full-service guy who gave you tips and charged a bit more. Or maybe you used a discount broker who just did what you told them to. But either way, the whole system moved at the speed of a person, not a microchip.
Yeah, that world is pretty much ancient history now. Today, we've entered the age of the trading machines. This is where human gut feelings have been replaced by pure computational logic and just unbelievable speed.
And you can really see the evolution right here. On the left, that's kind of like algo trading 1.0. It's a simple, rule-based system. If this happens, then do that. Pretty straightforward. But on the right, whoa, that's the new school. That's a deep learning model. It's a web of connections designed to find incredibly complex patterns, stuff a human brain would never, ever be able to spot.
So how do these things actually work? Well, you can boil it down to about 4 steps. First, they just hoover up insane amounts of data. Not just prices, we're talking news headlines, satellite images, social media sentiment, you name it. Then, they train themselves on all that history, learning what patterns usually lead to what results. Step 3 is the real-time hunt. They scan the live markets for those signals they've learned. And finally, boom, they execute a trade automatically in a fraction of a second. So the big question is, do they actually work? Well, take a look. This chart shows a few different machine learning models trying to trade crude oil. Anything above that one line means it's making money. And you can see that the gray line, the random forest model, consistently does better than the others. The takeaway here? Not all algorithms are created equal.
The right kind of model can, in fact, find a real profitable edge in the market.
But, and this is a huge but, it's not some magic money printing machine. Not even close. There are some serious risks, some real ghosts in the machine that can cause these brilliant systems to fail spectacularly. And the number one ghost, the biggest danger, is something called overfitting. Here's the best way to think about it. Imagine you're studying for a big exam, but instead of learning the actual subject, you just memorize the answers to last year's test. You'd get a perfect score on that practice test, right? But the second you walk into the real exam with new questions, you'd be totally lost. That's exactly what an overfit model does. It gets so good at explaining the past, including all the random noise and flukes, that it completely fails when it faces the future.
And it's not just overfitting. There are a ton of other risks. A strategy that looks unbeatable in backtesting can just break the first time it encounters a crisis it's never seen before. You also lose that human element, that person who can look at the screen and say, wait a minute, this doesn't feel right. And that means that a perfect track record from the past, it can be a complete and very dangerous illusion.
This is exactly why you're hearing calls for caution from institutions like the CFA Institute. They put it perfectly, really. You need sufficient human oversight, governance, and accountability. In other words, you can't just build these things and let them run wild. At the end of the day, a person has to be in charge. A person has to be accountable for what the machine does.
Okay, so you've got this invisible, high-speed war of the bots happening every single day in the markets. But why does any of this matter to you? Well, because this quiet battle of algorithms has some very loud, very real-world effects. Now, let's be really clear about something. The algorithms aren't deciding that oil should fundamentally be $80 a barrel. No, the big picture price is still driven by old-fashioned supply and demand. You can see here, things like global demand and supply shocks, they account for the lion's share of price moves. The bots don't create the wave, so to speak.
But here's what they do. While they don't create the wave, they can make the ride a whole lot choppier. Their super-fast trading can take a small price ripple and amplify it into a huge, volatile wave. And those bigger, more extreme swings, they can eventually find their way to you, influencing the price of everything from your morning coffee to the gas you put in your car.
And this chart is a fantastic reality check. It shows how one AI strategy performed on a bunch of different commodities. Just look at the difference between crude oil and natural gas. The results are all over the place, and they change constantly. This just goes to show, even with the smartest AI, there's no free lunch. It's still a tough, volatile battle against a market that is fundamentally unpredictable.
So that brings us full circle, back to that impossible price of negative oil. We've seen how these incredibly powerful algorithms are rewriting the rules of the game, operating at a speed we can't even comprehend. And as these trading machines just get smarter and faster every single day, it leaves us with one pretty massive question. Who or what is really in control of our global markets?